The clear dominance that the financial crisis delivered to the big four banks has sparked other ideas to create a more level playing field for competitors and better value for the long-suffering consumer. Today, one such proposal by Dr. Nicholas Gruen from Lateral Economics, commissioned by the Whitlam Institute of the University of Western Sydney, was released. Nicholas Gruen is also a frequent advisor to Labour governments, and he joined me a short time ago. Dr. Nicholas Gruen, welcome to Lateline Business.
Hi, Vicky.
Now, your central message about improving bank competition is effectively to commoditise banking. How do you go about doing that?
Well, essentially, banking is already commoditised. If you're writing a home loan, it's a very simple business. So what the problem is that where these loans are being written, but the profit margins on them are not commodity profit margins. They're much higher than commodity profit margins. So effectively what I'm trying to do is to let smaller businesses compete for the business of writing home loans, and we can't do that by allowing the banks to have the very powerful position they've got in terms of the costs of funds. So that's essentially how I want to bring the prices of what mortgage writing involves down to commodity levels, given that what's actually happening is really a commodity business that pretty much anyone can do.
And you're going to do that by introducing insurance?
Correct. So at the moment, what we've seen from the global financial crisis is that the government is on the hook. It can't avoid being on the hook for really big losses that the banking sector might take. So
effectively people believe that these big banks are guaranteed by government.
Which is why they can raise funds so cheaply. So what I'm suggesting is that we make all that explicit. The government effectively sell, if you like, catastrophe insurance to the banks for their home loans. And while it's doing it, it can sell exactly the same insurance for Aussie Home Loans, Wizard and all those other people. That puts them on a level playing field, and that means that this commodity activity can then start to be the price of doing it can start to be competed down to the cost of doing it, which it assuredly isn't at the moment.
If we adopted this, you're also suggesting securitisation of pools of insured loans, effectively being traded like what, government bonds?
Well, that's right. Canada is a bit of a model for this, although the Canadian government has been more adventurous than I'm suggesting the Australian government should be. But once the government has guaranteed, say, 80% of the value of a house, or say 60% of the value of a house on a loan, that loan is free to trade with the security of a government bond. So that in Canada, a pool of securitised loans which is in this position with that sort of government guarantee can sit on bank balance sheets without any further capital provisioning, and more generally trades at 22 basis points to the bond rate, which is incredibly low.
Are there any concerns about this, though? Because after all, our securitisation market effectively dried up during the financial crisis.
Exactly.
People do talk about property bubbles.
Yeah.
Do you think that we really should be introducing a new securitisation market linked to property?
Well, we already have the market linked to property. This is a way of being explicit about the way in which the government is on the hook. It's not a way. I don't recommend this as a way to drive investment into home lending, because the reserve what it's designed to do is to get bank margins to competitive levels rather than the oligopolistic levels that they are at the moment. It's not there and wouldn't drive more of a property bubble. If it was doing that, the Reserve Bank would in effect take some of the margin back by jacking up rates. So I'm afraid I can't tell the tabloid journos that this is going to make life massively easier for home lenders, but it will make it a bit easier for home lenders, and it will make banking much more competitive.
Now, what do you think the chances are of the government adopting this perhaps in December? You've been very close. You've chaired their 2.0 task force, haven't you?
On a different subject. I fear that the government is not getting out enough and talking to enough people, and is getting advice from a fairly closed quarter, and might get some fairly conservative advice.
The Treasurer has come out, though, over the weekend. He wants to see other players, building societies, credit unions becoming a fifth pillar to the Australian banking sector. That's quite consistent with what you're saying.
It is indeed. And if by fifth pillar he means some structural changes to allow those small players to really compete with the big players, that will work. If it means, say, picking up a particular merger, for instance, AMP and AXA, I think that would be a good thing, but that's not going to solve our problem. So we'll see how it goes, and I very much hope the government takes the opportunity to do what's in its own interest, because I think it might find itself in quite a mess if it doesn't do enough.
What about this private member's bill that the opposition, Bruce Bilson, has put up today to allow the ACCC to regulate price signalling by banks?
Well, I think that's a bit of a sideshow. The strongest signal that the Commonwealth banks sent about prices was to put its own prices up by 45 basis points. That's a pretty strong signal. So all that kind of thing does is allows the ACCC to sort of yap at the heels of the banks, and that's maybe very marginally worth doing, but what the problem is the oligopoly power that they've got, and they don't really need to signal that because they all know each other have got it.
Dr. Nicholas Gruen, we can only wait till December. Thank you very much for talking to Lateline Business.